Hi everyone, this is David and Parker with the Gellner Team of Kidder Mathews. We're here on a beautiful summer day and wanted to put together a market update for everyone with some information that we think could be highly important to you depending on your situation. To kick this off, first and foremost, the first item we wanted to talk about is the Washington State's changes to the estate tax and what those tax rates look like. This recently happened within the last 30 days. And specifically, if you're in the $7 million or above tax bracket, you're now going to be at a 30% estate tax rate. So it was 20% for 7 million and above. Now 7 to 9 million is at 30%. 9 million and above is at 35%. Moral of the story, if this is new information to you, is definitely start having conversations to verify and kind of confirm your specific situation. For these estate taxes, 35%, $9 million and above, we are now the highest estate tax in the country by far. I believe Hawaii is the second highest at 20% capped estate tax. So just want to make as many of our clients and individuals aware of these changes. It's catching a lot of groups in our conversations off guard, although it did just happen 30 days ago. Definitely wanted to make sure everyone is aware of that. We're already having numerous conversations with our clients who are looking at their portfolios and potentially talking about selling some assets to move to different states because of this. So again, these changes in the estate tax brackets, very substantial. Please talk to your CPAs, accountants, attorneys. Make sure you're very well aware of this. We're happy to send additional information on this topic, but really wanted to make everyone aware. The second item, which is on more of a positive note, is bonus depreciation of 100% year one is back. As of this month, we have already seen a substantial uptick in our automotive and gas station investment listings that include the real estate component as well, just because 100% accelerated depreciation is back. And that's really driving a lot of buyer demand right now in those specific asset categories.
Definitely, yeah. I think, the 7-Eleven deal story that we've been talking about is, I know I was pretty blown away with the numbers once you were on the cost segregation, and how much you can depreciate day one was unbelievable for me.
Really good option for groups, especially higher net worth groups who are looking for some reasons to buy real estate and get that tax benefit, especially the high income groups. So if you have any questions on that, please reach out to us. But bonus depreciation is back. If you need a contact to run some studies, we have a great contact and referral that we're happy to send their contact information over. So please reach out to us with any questions. But overall, we believe that we're going to see a lot of demand, an uptick of demand from what we've seen, especially on the automotive side of things. So gas station, AutoZone, O'Reilly Auto Parts, Valvoline. We're already seeing that because that 100% bonus depreciation is so powerful. The third item we wanted to talk about just broadly is, are we seeing any changes in the retail landscape? If so, what are we seeing? The biggest item or category that we are seeing shifting landscape is in medium and big box assets. Specifically, we're seeing vacancy rates uptick in that category, which we think is really important to cover, because sometimes when you see articles come out for retail, you really have to segment and separate out, is it shop space? Is it medium box space versus big box space? We're still seeing shop space vacancy around or under 3% for the market at large. So that's still very competitive in a landlord favorable market. Where we've seen changes start to happen is specifically on the medium and big box. Vacancy rates are going up, and it's essentially been driven because of three major tenants. We obviously have had the Rite Aid bankruptcy in the works this year, starting to go through at those stores. So Rite Aid and Bartell stores, there's many dozen stores in the Northwest that are closing down. There were 39 of those Rite Aid Bartell stores that are now rebranding as CVS for those ownership groups. On top of the Rite Aid bankruptcy, we've had Big Lots. That bankruptcy has kind of unfolded along with At Home stores as the most recent kind of bankruptcy participant. So essentially, because of three large corporate tenants having financial issues, that has really increased the amount of medium and big box vacancy on the market. However, we are selling 3 vacant drugstores at the moment, and you want to talk a little bit about the activity we've been seeing?
Yeah, we've seen great activity on all of them actually, predominantly from owner user grocer backfills, some kind of miscellaneous retailers, a few folks that are just looking at these sites because they're in great locations just for storage space. But activity's been really solid. On the corporate front with tenants, it really depends if some of those high likelihood tenants are already in the market or not. And then like what we've talked about in past market updates with the TI costs as well, I think a lot of groups aren't prepared, I guess, for lack of a better word, on how much it costs to put one of these corporate tenants at a higher lease rate in, anywhere from $500,000 to $1 million plus, depending on the tenant and their use, TI improvements, everything like that. But I think that's caught some folks off guard. And then I think going with Rite Aid, the other thing now that we've got the CVS list that's out, if you own a Walgreens, I've been talking with a lot of our clients about if the Rite Aid in the market, where they own a Walgreens is going to convert to a CVS, because it shifts the market paradigm a little bit, where Walgreens used to be the premier drugstore and Rite Aid was secondary, to now CVS moves in. They're kind of the premier drugstore and Walgreens becomes potentially the B drugstore in that market.
Yeah.
And just, we won't know for sure, but just paying attention to store sales and reporting and where those Walgreens are going to be trending.
Yeah. Just to reiterate what Parker said, is on the if you own a Rite Aid store, a Bartell store, or even a Walgreens that went vacant, what do? We are seeing great owner user activity. Obviously, better location is helpful, but lots of demands from owner user groups, developers, or corporate tenants who want to go and build something new on site. So if you have any questions on that, give us a call or shoot us an email. We're happy to kind of talk through all the different options we're seeing out there. The last item we want to talk about specifically on retail investment landscape that we're seeing is essentially not a ton of changes. However, we are noticing from the buyer groups we're working with, along with the most recent sales comparables, is a flight to quality in simple terms. So what does a flight to quality mean in our world? We are seeing a separation between newer construction, so I would put that at 2000 or newer product versus product built before the year 2000. We're seeing specifically on multi-tenant properties, if we're talking about that asset class in general, multi-tenant newer product is seeing anywhere from easily a 50 basis point separation, assuming tenant quality is the same, just because of the newer building, up to 100 basis point difference in just really the year built construction quality of multi-tenant versus some older products. So we're seeing buyer groups, especially those that are migrating from other asset types like office, apartments, of course, industrial, flow into multi-tenant with a preference on newer construction properties. We've seen some recent comps trade, $5 million plus, anywhere from 5.5% to 6% cap rates, because there's such a demand for newer quality, higher quality product. And we've been talking about it, I feel like every market update, but it's just so difficult to build new multi-tenant shopping centers in our areas in the Northwest. So that's really driving the premium for the newer quality assets. Anything you'd want to add on that?
I think I've got a question for you. Just, I know we've talked over the past couple market updates on ground leases, and what you just mentioned spurred this thought of construction costs, but with bonus depreciation coming back, do you think that's going to push more people away from ground leases, where earlier this year that's what everybody wanted?
That's a great question. What I would say is, looking at behind the scenes and working with a lot of developers is for the product that's, let's call it a $2 to $4 million exit sales price, to go and do a build to suit versus a ground lease. Really, the ground leases is how new store counts are continuing to grow and new buildings are coming out of the ground for these tenants. The build to suits with construction costs still are really hard to make sense when you pencil the numbers. What I would say is on the ground lease front, we have seen a surge of ground lease kind of triple net product in the $2 to $3 million range. However, that is moving through the market pretty consistently. My one comment on that regard is with bonus depreciation coming back to 100%, we have started to hear more and more feedback from groups who say, hey, I love this $2 or $3 million triple net opportunity you sent me. That's a ground lease. Everything sounds great, but I want to own the building as well because of the depreciation standpoint and that being such a driver, especially for groups that need some tax help in year 2025. So we're making sure to relay that to our development clients and anyone else that, hey, if there's an option between a build to suit and a ground lease and the numbers may look pretty similar, maybe lean more towards 2025, looking forward to 2026, lean towards a build to suit. If the exit pro forma is similar, just simply because we are having an influx of buyers who want to look at owning the building and the land completely versus a ground lease. So that would be the comment on that. If you're out there listening to this and you have any questions on a project and want to look at the different numbers and exit values, we're always here. Please reach out to us. Any other questions that may be on the top of your mind, we're happy to hop on a call and walk through anything. But thanks for joining us on today's market update. And this is David Gellner and Parker Sadakis with the Gellner Team.